Okay, we're going to do chapter 5. Let's get started. Chapter 5 is one of my favorite chapters. It's really straightforward. No journal entries, no T accounts. It's really actually just calculating costs and figuring out what it takes to do things like break even and things like that. So in this chapter, we're going to go through cost, volume, profit analysis. And what that means is how does profit respond to changes in costs or changes in volume? So if we increase selling prices, what happens to profit? Or if we decrease selling prices, what happens to profit? Or if we sell more units, what happens to profit? So it's called CVP analysis. So we're going to come up with contribution margin and some different things like that. So contribution margin is a different way to organize an income statement. It's still an income statement and it still is revenue minus expenses as net income. But instead of dividing up our expenses as COGS and selling and admin, we're going to divide them up as variable and fixed. And so in this chapter, we're going to make bicycles. So we talk about bicycles all the time. But we're going to make stationary bikes. So the ones that you would see at the Y or Genesis or wherever you might go to work out. So those bikes in our example, we are going to sell them for $500 each. Every single bike costs us $300 to make it. So every time we sell one bike, we make $200. And then our fixed expenses monthly are going to be $80,000. So that means we got to sell a lot of bikes to be able to cover those costs because we have a lot of machinery and a lot of supervisors and a lot of rent on the factory, a lot of different fixed expenses that are involved in our business. And we've got to be able to cover all of those. So this last month, what happened for our company, Nord, is that we sold 500 bikes. So if we sold 500 bikes at $500 each, our revenue is $250,000. But if we sell 500 bikes, the cost is $300 each. So the cost is $150,000. So 250 minus 150 is 100 minus 80 is $20,000 of net income. Now I don't do anything with taxes until later. So that would actually be net income before taxes. And then I would need a tax rate to get to net income. But we're not going to worry about that for a while. So what we're going to do is we're going to go through the idea of contribution margin. So what is this concept? So normally when we look at an income statement, I'm going to go to the last page for a minute. Normally when we look at an income statement, we do revenue minus COGS is gross margin. So instead of gross margin, we're computing contribution margin. And so we're doing revenue minus variable costs. So when we're looking at our revenue and our variable costs to get contribution margin, if we look at them on a per unit basis, I'm going to use a lot of abbreviations in this chapter. So this number right here is going to be called SPPU, the selling price per unit. And this number is going to be called VCPU, the variable cost per unit. So the selling price per unit is 500. They cost us 300. So every time we sell one bike, we make $200. So contribution margin per unit is the amount left over from each unit sold to cover fixed costs. And then after covering the fixed costs, so what I'm trying to do is the amount left over from each unit to try to cover these fixed costs. And then after we cover the fixed costs, use some air quotes, it contributes for profit. So it contributes for profit. So once we can cover all of the fixed expenses, then it will contribute toward profit. So this next page is going to help us to understand that idea of contribution margin and what I'm really talking about there. So on the next page, I want to look at what would happen in our bike example if we only sold one bike. So we have a terrible month. The month is bad and we only sell one bicycle all month. So I want you to keep in mind that the 500 and the 300 and the 80,000 are going to remain constant unless I tell you to change them. Okay. So those numbers do not change unless, you're told that you're going to sell them for more, or you're told that the costs are going up or something. So if we only sell one bike, and oh, by the way, there's these percentages, and I'm going to cover those in a little while. So right now, don't worry about them, but don't worry, I will talk about them later. Okay. So we sell one bike for $500. And if we only sell one bike for the whole month, then our total revenue is only going to be $500. Our variable expenses are going to be $300 and our contribution margin is $200. But our fixed expenses are a lot. Our fixed expenses are $80,000. So our loss, we have a loss in this case, a loss of $79,800. That's a bad month. Okay. So there is definitely more work to be done. We cannot just sell one bike. So the next example I want to look at is what if I sell two bikes? So I doubled my sales, yay for me. So instead of 500, it's 500 each times two bikes. So that's 1,000. And then my variable costs, instead of 300, it's per unit, two bikes. So now it's 600. So now my contribution margin is 400, but my fixed expenses are still 80,000. So now instead of losing 79.8, I only lose 79.6. So what's happening here is every time I sell another bike, I'm trying to cover the fixed costs. And if I don't cover the fixed costs, I'm going to have a loss. And so every time, if I did 3 bikes, then it would be 1,500 and 800 and is that 800? So 1,500 and 900 and 600 and 80,000 and 79.4 as a negative. And if I sold 4 bikes, then it would be 2,000 and 1,200 and 800. And then I would have a loss of 79.2. And I would just keep trying to sell enough bikes to be able to cover that fixed cost. And so the contribution margin, we must first cover the fixed cost. If it doesn't, we have a loss. As additional units are sold, then what's happening is we're whittling away all those fixed costs until they've all been covered. So the next thing I want you to do is I want you to sell 400 bikes. So when I'm doing this in class, I make them compute it, and then I wait for them to get done, and then I ask them what they got, right? So you can always pause me and you can try to go ahead and compute it. So 400 bikes at 500 each, 400 times 500 is $200,000 of revenue. 400 bikes at 300 each is 120,000. So that leaves me with 80,000. And my fixed expenses are exactly 80,000. So this is called the break-even point. It's where my net income is 0. And so I exactly sold enough bikes to cover all of my fixed costs. So then if I sell 401 bikes, then 401 times 500 gives me 200,500. 300 times 401 would be 120,300. And that gives me 80,200. My fixed expenses are 80,000. So now finally I have profit. So once I meet the break-even point, after I cover the fixed costs, then I contribute toward profit. So let's go back to our first page and let's read that definition again. Contribution margin per unit is the amount left over from each unit sold to cover fixed costs. And after covering fixed costs, it contributes toward profit. So in short, it first contributes to fixed cost, and then once it covers fixed cost, then it contributes to profit. So if we sold 402 bikes, then this would be 201,000, 126, 80,400, 80,000, and then I'd have net income of 400. Okay. So the break-even point is where total revenue equals total cost. And it's also where net income equals 0. Sounds like a good thing to put there. And so we can see that at the break-even point, total revenue is 120 and total costs is 120. It's also where contribution margin is the same as fixed costs. It's also where net income is 0. So those are 3 different ways that I could talk about that break-even point. So it's where it's 80 and 80. It's where it's 200 and 200. It's where net income is 0. Okay. So what we see here is a graph, and I get super excited when we get to the graphs because I love making graphs. And so that means I'm weird. So what I like to look at when I'm making these graphs is the fact that way back when, maybe 2002, I taught intermediate algebra for a community college. And so they wouldn't let me teach college algebra because I don't have a degree in math, but they let me teach intermediate. And I remember loving doing that because people that are in intermediate algebra often don't love math. It's not their favorite thing. And I love trying to take it and make it simple and make it like find ways to make sense of it. So what we see here is a contribution margin graph. And so remember that when we graph, we always put dollars on the Y. And we did graphing way back in chapter 1, I think. So we always put dollars on the Y, and we always put like activity or units or whatever on the X. And so on the X, I see number of bikes. And right now we're selling 500 bikes based on the first page. And so I can't write here. And so you're going to have to just write on it by listening to me. But this line right here, this line starts at 0. That's called the revenue line. So I usually write the word revenue on this line, like on it at a diagonal. So I write the word revenue right here. And I know it's the revenue line because the revenue line always starts at 0. Because if I don't sell any bikes, I don't have any revenue. So revenue is 0 right here. So as I sell 200 bikes, my revenue goes up. As I sell 400 bikes, my revenue goes up. And as I sell 500 bikes, my revenue goes up. So this line is increasing at a rate of $500 a bike, because every time I sell one bike, I bring in $500. So this line is called my cost line. And my cost line starts at 80,000. And that's because even if I sell 0 bikes, I still have to pay 80,000. So that's my fixed cost. That's my y-intercept. So in my y equals mx plus b, that's my b. Okay, so this line starts at 80,000. And so right here, diagonal right here, I usually write cost because this is my cost line. And so my revenue line always starts at 0. My cost line always starts at the fixed cost. Now this line is going up. Every time I sell one bike, it costs me $300. So every time I sell one bike, it costs me $300. So this one's slope is 300. Whereas this one's slope is 500. And so eventually the revenue line will overtake the cost line and we'll have more revenue than cost. And that happens because this line is increasing at a faster rate, because every time I sell a bike, I bring in $500. And this one's only going up at $300. But we have to cover all those fixed expenses. And so this horizontal line here is just my fixed cost. So this point right here, like I can't click on it really, but this point right here where my 2 lines cross, that's called the break-even point. So I usually draw an arrow to it and I'm like, that's break even. And I can see that it's 400 bikes. 400 bikes is what it took me to break even. And 400 bikes is 200,000. And my revenue would be 200,000 and my total cost would also be 200,000. So if I'm selling less than 400 bikes, then I have a loss. And so this little area in between right here, I usually write the word loss. And when my revenue line overtakes my cost line right here in this little area, I put profit, because that's what I'm making money. Okay. So let's go ahead and let's look at some equations. And the first thing I'm going to say about these equations is you don't have to memorize them. Okay. So don't panic. There's nothing to memorize. I know that in general, your exams are somewhat open book, so you don't really have to memorize anything anyway. But when I'm talking to my day students, you don't have to memorize them because you're going to use them and you're going to know them and understand them. And you're going to be able to basically solve any question by building an income statement. So you're not going to have to memorize the formulas. But I like the formulas because they help me to understand a lot of other things. So I want to start off with the cost equation. And the cost line is the one that starts at 80, right? It starts at fixed loss cost. So this is the cost line. So my total cost is Y. And so if I'm looking at my letters, this is a good page to go back to if you're looking for abbreviations, because you know that I talk in letters a lot. So the total cost is Y. The variable cost per unit is M. X is your activity and B is your fixed cost. So my total cost, if I sell one bike, would be $300 a bike times 1, which would be 300 plus 80,000. So my total cost would be 80,300. And I would only bring in $500. So then I would have a loss of 79.8. So my revenue line is based on a selling price per unit of 500 and then the number of bikes I sell. So if I sell 2 bikes, I would say 500 times 2, 1,000. Okay. So here I want to go ahead and write it as letters. So total cost equals VCPU. So let's go ahead. Assume it's under there. Yeah. So total cost is VCPU times the quantity plus the fixed cost. So my total cost in my bike example, if I sell 3 bikes, would be $300 per bike times 3, which would be $900 plus 80,000. So 80,900. Okay. If I sold 400 bikes, then I would say 300 times 400 bikes is 120,000 plus 80 is a total cost of 200,000. Okay. So that's the cost line. And then the revenue line is SPPU times Q. So to find my revenue, I just say $500 a bike times however many bikes. So I like to look at this profit equation because everything kind of stems back to this. And like I taught you guys what profit was in the first chapter of financial accounting. Like to get our net income, it's just revenues minus costs, right? Revenues minus expenses is net income. So revenue minus your cost is your profit. And so then what I like to do is I like to take the revenue equation, which is this, and I like to take the cost equation, which is this, and then I would do total revenue minus total cost to get profit. So you'll see what I did. And again, at this point, this is where students' eyes kind of glaze over and they're like, what is she even talking about? But total revenue is SPPU times Q. Total cost is MX plus B. M is the variable cost per unit, X is your activity, and B is your fixed cost. So what I want you to notice is, and I was actually, I think Tor did it more than I did, but today we were trying to teach Andrew how if there's a negative outside of the brackets, so he's 13 and he's in 7th grade and he's learning like just the basics of algebra right now, but that negative will hit both of those numbers inside of the bracket. So that if it's negative 4 times this quantity, then you got to do it all times each other, right? So you have to distribute the negative sign through. I think that's the right math term. So what we would do is we would say SPPU times Q minus BCBU times Q. And then this minus is minus of this whole number inside of the bracket. So it would be minus your fixed costs. So what I want you to notice is you're taking SPPU times Q and you're also taking BCPU times Q. So we could say the difference between SPPU and BCPU times Q minus your fixed cost is your profit. So if I want to write that out a little bit better, I remember that SPPU minus BCPU, selling price of 500 minus 300 is your contribution margin per unit. So CMPU times quantity minus fixed cost is profit. And I don't ever use this formula for anything, but it helps me to understand the break-even formula, which I'm going to show you in a minute. Okay, so as I'm looking at this, this is just a reminder that SPPU minus VCPU is CMPU. And what I want to show you guys is what it actually takes to break even. So cost volume profit analysis, that's what this chapter is all about. That works. How profits change based on cost or volume of goods or services provided to customers. So our profit is going to change, like we're going to go up or down based on selling more units or selling it for a different price or anything like that. So it's used as a planning tool for pricing and product decisions. The break-even point is such an important point to us because that's the minimum that we have to operate at or we're going to lose money. And we need to know what that is in our business. And if you went to your work tomorrow and you're like, what's our break-even point? They'd be like, I don't know. But if they think about it, they can figure it out based on like how much they normally sell, what they normally sell stuff for. Now, I understand that in most businesses, we don't have a one product line, which is what we're going to have in a lot of these problems we're doing. But just keep in mind that we can do it as a percentage. That's what those percentages are for. And I'll come back to those. So the things that we're going to keep in mind is our SPPU will be constant. So if we sell bikes for 500, we're going to keep that constant while we're doing these calculations for break even. Also, our VCPU is constant. And also our fixed cost in total. I should write that out. Cool. Fixed cost in total are constant. I don't really have enough room to write that out, so sorry about that. So fixed cost in total are constant. So 80,000 for our bike example, 500 is our selling price and 300 is our variable cost per unit. And so we're going to assume that as we're doing this, that what we sell is what we produce. So even if we keep an ending inventory, that it kind of stays constant. And also if we have more than one product line, that our sales mix is constant. So that, 20% of our sales come from, the grocery division or whatever. So we need our mix to stay constant if we have multiple product lines. So this is an example. This is just a picture of our contribution margin income statement. And so we sell our bikes for $500 each times the number of bikes. We sell our bikes for the variable cost is $300 each times the number of bikes. And our contribution margin would be $200 a bike times the number of bikes. So total revenue minus total variable costs, contribution margin minus fixed costs is profit. So our break-even point, we've already identified that. It's where net income is 0 and it's where our revenues and costs are the same, but it's also where contribution margin and total fixed cost are the same. So if we want to see that, basically, if profit is 0, then these two numbers have to be identical. Okay. Another way to see that is if we go back all the way back to page 2 and we look at the break-even point, it's where contribution margin and fixed costs are the same. It's when we're selling exactly enough to cover our fixed costs. So our formula to be able to break even, all we literally have to do is we need exactly enough units to cover the fixed cost. So all you have to do is take 80,000 divided by 200. And if you take 80,000 divided by 200, you would get 400 bikes to break even. So our break even point is 80,000 divided by 200. So put a big star next to this equation because this is the equation we're going to use over and over again to be able to calculate our break even point. So you'll take your fixed cost of 80,000 divided by your CMPU. Okay. So our selling price in our bicycle example is $500 and our variable cost is 300. So our contribution margin is 200. Our fixed costs are 80,000. So to break even, all you need to do is take fixed cost divided by CMPU. And so I guess I don't have enough room to write that like that. And so
Bottom one.
hi, Tor. Builder watch this one day. Oh, buddy. 80,000 divided by 200. And we would say 400 bikes. Okay. So 400 bikes is the number of bikes we need to sell to be able to break even. So if we want to convert that into dollars, then all we have to do is say 400 bikes. And what do we sell one bike for? Our selling price for one bike is $500. So that would be 200,000 in revenue. Okay. So, all right. I think this is a good place to stop, and then I'll finish the video because we're on page 5 now. So I'll finish with the other half. So.